Ethan, I think we are live.
Yeah, we're live. Okay, perfect. So, hello everyone. I'm so excited to introduce you to the next speaker, Gil Epen. Gil is CEO of Decision Options LLC. He's based in Connecticut, and he will be speaking to us about artificial intelligence for decisions. I'm really excited about his keynote. So, without further ado, the stage is yours, Gil.
Thanks, Midhan. Let me just share my. Can you see my slide?
Yes.
Good morning. Hello, everyone. Thank you, Y Summit, for inviting me here to provide some thoughts. I'm going to be talking about capital and resource allocation decisions, combining econometrics with artificial intelligence. So the focus here would be PPM, but from an economic perspective. So at the end of the day, as PPM practitioners know, we have to make better decisions that drive shareholder value. And so one question always is, how do we connect PPM decisions to senior management decisions and ultimately shareholder value? I would say that this is certainly not new. I was at Pfizer in the 90s. My team put together a machine learning-based portfolio management system for Pfizer in the mid-90s before Google was founded. And that was responsible for allocating $4.5 billion. So the ideas are certainly not new. But there are some characteristics that I know that most people are thinking about when they think about PPM. So any investment decision in the pharmaceutical context, it could be an R&D program, a marketing campaign, a manufacturing plant, a licensing deal. It has three interrelated attributes. So it has an economic value. It has a value for the company. It has a downside risk. If things fail, the company is going to lose some value. And it has an upside potential. If things work out, perhaps a higher level of value will accrue to the company. So when we think about PPM, there are three, at least in my perspective, three buckets of decisions. The first one is selection. So when you have multiple programs, projects, how do we select the most valuable ones? The second is design, which is we have decided to do a program, but there could be different ways to do them. There could be different designs that we could think about. And those designs, in many cases, are mutually exclusive. So we are trying to figure out what design might be most optimum. And then when there is a large number of projects and programs in the portfolio, we have the portfolio management problem. And when we think about resources, there are four types of resources, as everybody is aware of. So there are people, there is money, there is space. Space is sometimes constraining for projects and programs, and there is time, also a constraining resource. So we don't have infinite availability of any of these things. So portfolio management decisions are really about a constrained optimization problem. Now here, I might deviate a little bit from conventional thinking. So investment decisions are really driven by three considerations. One is uncertainty. And uncertainty is pretty clear to most PPM practitioners. But there is also this idea called flexibility, which is when we make a decision, we have future decisions to make that are interrelated with the current decision. And those decisions would be made in the future, and we can wait for those decisions to be made. And that gives us some flexibility when we think about a program design or a project planning decision. And obviously, there are interactions between projects. Projects don't stand alone. They interact with each other. And so that has implications for valuation. And so from a process perspective, you can think of this as sort of a circle of interaction. So we have uncertainty, flexibility, and interactions driving economic value in projects. So we can compute that. Those valuations, downside risk and upside potential, allows us to make those decisions. These decisions then drive our resource allocations into projects, but oftentimes we may hit constraints here that might force us to go back and think about the projects again. And so it is an ongoing process. So what do we mean by uncertainties? Uncertainties come perhaps in two buckets. There's a macro uncertainty. COVID-19 is a good example of this, a systemic uncertainty that affects all projects. And then there are micro uncertainties, cost, timelines, market potential, technical risks, competitive actions, and so on. There are two types of uncertainties. One uncertainty, what we call stochastic, or a time-wise uncertainty. So if the growth of the economy is one such uncertainty. It is evolving over time. Cost of materials could be a similar one. But then there is also probabilistic uncertainty. So this is a probability of something going to happen. In the pharma context, we are all familiar with attrition of an R&D program. That's a technical risk. That's a probabilistic uncertainty. But there are other things like competitive entry, technical feasibility, and so on that also have probabilistic characteristics. So what we mean by flexibility, as I mentioned, these are decisions that we have some flexibility about in the future. So we can initiate different programs, we can stage them, we can delay decisions, we can accelerate, slow down, abandon, and we routinely do this, all of these things, into the future. Now, I would argue that the conventional tools that looks at valuation of projects and programs are not really doing this in a systematic way. So many of the financial techniques that you might be using, like discounted cash flow analysis or Excel models, won't allow you to do this in a systematic way. And the third attribute is correlations or interactions between projects that we are all familiar with. So there are correlations between projects in a portfolio, but there are also events that might have a systemic effect on all projects. So we need to consider that too. So I'm going to take you through a process or a construct. This is an R&D program in a pharmaceutical company. And many of you are familiar with this. You have stages of R&D programs. So you have phase 2B, there's a drug sitting in phase 2B. Time evolves from left to right here. And we do a phase 2B program, and some probability it's going to succeed. Then we will do a phase 3 program. And if it is not what we expected, we might license the product out, or we might take it to further into phase 3 and eventually come to market. So all these decisions that we make are sort of interrelated. So when we make the phase 2B decision, we have to be at least aware of what the future decisions are and uncertainties around them, and how do they ultimately affect our current decision. And so what happens in conventional finance is that we might do scenario analysis, we might do even Monte Carlo simulation, and typically what we will get is sort of a normal looking distribution. And then that's because we have taken uncertainties into account, but we haven't really taken flexibility into account. So when flexibility interacts with uncertainty, the decisions behave more like options and less like a cash flow type decision. And so the picture on the right is what most R&D programs are going to look like. Most projects, most programs you deal with have a low probability of losing, I should say a high probability of losing small amounts of money and low probability of making large amounts of money. So this is why pharmaceutical companies have a portfolio of R&D programs so they can diversify the risks away. I won't spend too much time on this. So there are multiple areas where these differences are coming from. We don't take correlations into account sometimes. we may assume that our costs are deterministic, are known, so we can plug that into an Excel spreadsheet. Often we have a lot of uncertainties around cost of goods and a variety of other costs that the company may incur. We typically, in a conventional financial analysis, assume there is only one path forward. But as you know, there are many, many different paths that the company could take. And that is going to make a difference. Timelines, for instance, in a conventional way, we have to put in numbers. We have to say a phase 2B program takes 2.5 years or whatever it is. But it's not necessarily true, right? We have uncertainty around that. And we might assume the attrition rates in R&D programs are binary. But oftentimes in a pharmaceutical program, we are pursuing a label so that the program may not completely catastrophically fail, but we may get a label that we did not anticipate. And so in effect, the risk, the attrition risk that the company carries is not necessarily binary, it is more probabilistic. Future decisions are mechanistic. That's a big assumption. We make future decisions when we get to the future. So we cannot really arbitrarily say we will make one decision and the cost of the decision is X when we are sitting all the way back in phase 2, for example. And then obviously there is a lot of uncertainties in the markets, including reimbursement, competitive entry, and so on, which we can't really deterministically carry. And so there are a lot of differences that make the value of a program quite different from traditional analysis. So we have been working in this area for about 20 years. It's not just pharmaceuticals. We do the same thing in aerospace, energy, high technology, manufacturing. And with increasing interest in artificial intelligence, we can use structured or unstructured data or data emanating externally or the data that the company has internally to derive all these uncertainties that we talked about, whether they're stochastic or probabilistic, using machine learning and deep learning techniques. And we will use those in the economic modeling that we have to ultimately answer the question, how much is something worth, or what decision might be optimum for the company, whether it's a project selection decision, design decision, or ultimately a portfolio management decision. So here's an example of a selection decision in a pharmaceutical company. The company has 3 different projects it's considering, and they're all in the same area. These are HIV projects in this case. And we can value all 3 projects, taking all those uncertainties that we talked about and future flexibility. And we look at them in a portfolio context here. So there's downside risk on the x-axis in millions of dollars. There's upside potential on the y-axis in millions of dollars. And the size of the bubble here represents the value of the program. Now, this decision is not as straightforward. This decision is probably a little bit straightforward. We have the highest economic value program here in the middle. It has a little bit higher downside risk than another program, but the economic value of that is substantially less. So given this type of a construct, the company will likely go after the program in the middle. Now, oftentimes, we don't have such clean decisions, and I'll show you some examples of that. Let me talk quickly about a design decision. So this is a situation where the company has future expectations of internal R&D growth, and it has different scenarios or uncertainties around them. And the company is looking at constructing, this is a liquid dosage manufacturing plant internally, or how to really design that plant. And so given that uncertainty, given the plant's characteristics, we can look at the size of the plant. We can look at perhaps the company goes out and does that by itself, maybe seeks capital or collaborators and so on. So we can look at designs and answer the question, what design might be the best design for the company. So going back to portfolio management decisions, this is a look at all R&D, all clinical trials that are under play in a pharmaceutical company. And each bubble here represents a clinical trial. And again, on the x-axis, we have downside risk. On the y-axis, we have upside potential. And one look at this would tell you that this is a fairly biased portfolio in the sense that we have one large program here, immensely valuable for the company, but it also has high downside risk. And so if this is a company's portfolio today, if that program succeeds, the company is going to do really well. If that program fails, the company may have difficulties. So in situations like this, when we make that portfolio decision, we might also ask design questions, which is, can we redesign this program to make it less risky? So we can try to move it in this direction. If you move it in this direction, obviously, it also reduces the value of the program. But sometimes the companies may work with a risk budget. They don't want to exceed some downside risk budget, in which case they have to redesign this program to bring inside that budget. And so it's the same picture here. So we can select a program, select a set of programs within a set of resource constraints, people, dollars, space, and time, as we talked about. We can redesign and move things inside a risk budget. Ultimately, the decision here is to figure out what is the portfolio the company can reasonably pursue, given its resource constraints and all the risk characteristics. So if you sort of look at this at the company level, a pharmaceutical company, for example, has a variety of assets, access to markets, brand, processes, products, platforms, patents, R&D, capability, and even infrastructure and contracts, and all of the economic value for the company. And so we can go back and look at all components of a company and ask the question, what is that company's value might be? If this company is publicly trading, the stock price of that company would be analogous to the value that we compute here. And empirically, we can show that stock prices follow this process and not the conventional financial methodology that we pursue. So we have been building a technology around this, which takes, as I mentioned, any kind of data that the company might be collecting and organizing. So this could be legacy systems, it could be standard databases the company may have installed, and all that data could be looked at in a systematic way. And data here are resourcing data, cost data, attrition type, risk type data, market potential, all the components that ultimately affect the value of a project or a program. And you could think of this as a real-time process. So one of the problems with, not a problem, but I would imagine the status quo of PPM is that we don't really have the luxury of looking at projects on a continuous basis, whereas we do this in the financial markets all the time. But in operating companies, we do this at some specific time interval, let's say quarter or per year or something like that. But with technology now and with methodologies and tools that we have, it doesn't have to be a specific time horizon. It can be something that we can do on a continuous basis. And this also means that decisions can be on an exception basis. And oftentimes, we can automate decisions, and exceptions from what we expected to see may be looked at by humans in a more elaborate way. So rather than looking at all projects on a sequential, not a sequential, on some frequent basis, what we want to do is to look at all projects real time, but also look at projects that don't seem to make sense from what expectations were, and look at them using human expertise and intuition. And so the way that these types of things are implemented nowadays, and this is not just pharmaceuticals, it is happening in healthcare provider arena. It's happening in aerospace, manufacturing, high technology, where you have these models, artificially intelligent models that work from the clouds, that use emerging data from the company. So the company may have a new program, let's say, and that program has some expectations on its parameters. And given a model in the cloud, we can pass that program parameters to that model. It can produce a decisionable construct. In this case, is some probability of an outcome that allows the company to make a decision. Now, these models, these AI models, are not static. They are learning models. And so what these models do is that as more and more information comes in, as the company does more and more projects, the models will improve over time. And so, the models are keeping track of what decisions the company made. So it's a full circle. What decisions the company made, what data was available when those decisions were made. And we can ask the question, if we didn't get it right, how would we improve those decisions in the future? Now, PPM processes may do this using people, but now technologies are able to learn from their own mistakes and become better over time. So I'll stop here. I have written quite a bit about this in a couple of books published actually a long time ago, over a decade ago now. I also have a plug for my podcast. It's called Scientific Sense, where we interview, it's unscripted conversations with leading academics on emerging research. And it's topic agnostic. So we talk about life sciences quite a bit, but also physical sciences and social sciences. So Mithun, I'll stop here. I don't know if you have time for questions. We may have 5 minutes or so.
Thank you, Gil. That has been fantastic presentation. I really like the fact that you are talking about this future pacing, because most of the reporting we do in portfolios is like backward or past data, and you are really thinking about how can we make future decisions, how can we use more predictive analytics, how can we use artificial intelligence. I really like the fact that AI can be used for economic modeling. I like that fact that you are talking about making design decisions for portfolios. A lot of the times the design is not really the perfect fit, and you keep trying to fix things and it doesn't fix because your design was never well made in the first place. And then you talked about biased and unbiased portfolios. I really love this this way of putting it. And of course, yes, and we do need to think about it. And I like how monitoring value components can be made it consistently, and how we can automate. So really thankful to everything that you've offered to your community today, Gil. And feel free, everyone, if you have questions. We still have 3 minutes with Gil. And feel free to go to his podcast. I will put the link to the podcast on this in the chat, so that you can check it out. And
maybe I'll just Mithun, I'll just leave my email here too. If people have questions in the future, they can just email me as well. Yes, so one thing I would want to just stress is that there is a little bit of a disconnect sometimes in PPM and economic decisions at senior levels. And so, by connecting them robustly, PPM can get better, and senior managers can understand sort of all the operating complications, let me say it that way, better, right? So these are not necessarily financial decisions, but they're operating and strategic decisions that they have to really understand.
Wonderful. Thank you. I'm just posting for everyone who would like to go to check out the podcast. So this is the podcast of Gil that he talked about in his presentation. And about, I see that are the slides going to be available? So
Yeah.
all the presentations, yes, and they will be, the presentations are recorded, and they will be available on the PPM workout, which is a community of all the participants from these conferences. So it's really a social network for PPM, which has been created by PPM, by the Y Summits team. So after the conference, you can register, and you will be able to access the videos of this conference and also all the previous PPM summits. So feel free to take the time, and there will be also other events, webinars, which will be announced on that PPM workout. So thank you, Gil, for everything. Very insightful ideas, and certainly a lot to put in place, and really like the way you are helping us as a community to move forward with automated and future-paced decision making.
Thanks so much, Nitin.
We'll go quickly. We'll go backstage, and I'll come back with the next speakers with a panel. So see you.